it'll be interesting to see, in the next year or two, where that 10-year Treasury yield goes. I think for all of us as investors, it's very important to keep an eye on that. Not just simply what the Fed is saying or what they're going to do, but what uh, market participants in the bond market and what they do with their real money. And as they like to say, the Fed does not have control, or at least direct control, over the long end of the Treasury yield curve. In other words, 10, 20, 30-year bonds. However, what was also interesting is that in that September 18th announcement, the central bank made no change in its uh, un, un, what do you call it, a runoff of
Okay. Hmm.
mature debt securities on its balance sheet.
Hmm.
In other words, the so-called QT, or quantitative tightening, is
Right.
proceeding at the same pace as it was before this initial rate cut. We are at 7.1 trillion in debt-related assets on the Federal Reserve balance sheet as of today.
Hmm.
And the peak was around 9 trillion. So
Hmm.
they've actually made progress in letting the matured Treasury and agency-backed mortgage securities to just run off the balance sheet.
Right.
And they're making profits of it, which is actually good for the bank. But if they continue the current rate, which is something like around 60 billion a month, then we could see by the end of 2026 that Fed asset balance sheet down to around 5.5 trillion, which
Hmm.
is not far from pretty much the peak that we saw in the Fed's balance sheet in the 2010s. And there's a lot of numbers I just threw at you guys, but it's very important to keep that in mind, because when they're selling the treasuries, there's somebody got to be out there to buy them.
Yeah.
And a low low interest rate environment for the U.S. benefits pretty much all parties. The investors, especially from those overseas, it benefits corporations as they borrow to acquire other companies, to invest in R&D, to increase stock buybacks or pay dividends. And also, it makes equities competitive as an asset class. So,
Right.
the 10-year Treasury yield is going to be something I personally am going to be really watching closely from here on as well.
Yeah, of course, it doesn't benefit everybody. The typically when you have the low rates, what it always is kind of a rough time for savers, right? If you're holding cash, if you like to save cash, that's where it's not as good for you. But that's why it has that stimulative effect, right? Because it's,
Hmm.
hey, I'm not getting a good return holding my cash. I better use it for something. I better invest it elsewhere where I can get. And to your point, yeah, the runoff, as these securities mature, just by the nature of not, rebuying, it reduces that balance sheet. And that's incredible. I hadn't been paying attention to what some of those numbers are, but it's good, really good context that you're giving there. If we can kind of go to the slide before this one, just to kind of give a little bit of a more near term look. This is kind
Yes.
of our short term look here. And this only goes back to 2020, and I think it's worth mentioning that these, when you say, are we going to go back to zero again, the going to zero wasn't good, right? It was kind of emergency procedures, like ejection seat time, where it was, it's not a button you typically want to press, but we
There you
had
go.
situations where with COVID and
Yeah.
with the housing bubble, where the Fed did kind of put that, hit that emergency button, and did bring rates to that very, very low level. So anything that you wanted to kind of mention on this one before we go on to our next slide?
Well, I really like the way you framed it, Justin. Uh, Not only did the Fed go to zero on the Fed funds, they went, crude oil went below zero. That
Yeah,
was a
right.
crazy time, right? The futures on the crude oil
I will pay you to take my
to
oil.
take my oil. And then, in a way, you could argue that the Fed went below zero in terms of interest rates, because they backed up. It created all of these credit facilities, short term, temporary, but facilities to make sure that people didn't throw all the corporate debt out the window, which could have
Yeah.
which could really lead to some incredible economic depression amid a 100, once in a 100-year pandemic. So
Mhm.
incredible times we have lived in. Just when we thought, like, 9/11 and the great financial crisis were bad enough, 2020 was quite something that we all learned from and survive,
Mhm.
which is great. And the uh, the the other reason why we wanted to show this slide is because of your astute observation that, hey, okay, if the announcement on September 18th shows that by the end of the year, the Fed FOMC committee members believe that, among the consensus, where will the Fed funds rate be? Well, right now, I think they're predicting between something like 4.25% and 4.5%. So if you look at that chart, that only goes down a certain amount, and then if you go to the end of 2025, they're thinking 3.25% to 3.5%, which is still, well above that 0 to 0.25% historic low level.
Mhm.
Uh, the other thing that we want to look at right now, exactly, this is the other uh, chart that or table I wanted to share with everyone, is that in the beginning of the year, uh, the the bond market predicted that we would have something like 6 to 8 rate cuts, whereas the Fed, during its dot plot a year ago, predicted only 3 to 4. It looks like, the Fed is pretty much more accurate about itself than the market.
Right.
you know,
Yeah.
and if you look at this closely, you'll see,
Powell was saying this is what we expect to do,
right,
and the
right.
market just didn't believe him, right?
They didn't believe him. Yeah, exactly. And so, uh, now, of course, now I've talked to some people on Wall Street, and they said, yeah, we don't believe what the market believes either.
Mhm.
We and some bond investors got hurt by buying too early. Fixed income bonds, because interest rates actually rose. We had 3.73% on the 10-year earlier this year, and so, or excuse me, not 3, was it 3.7? I think it was actually 4.3. Excuse me, we're at 3.7 now, and but now if we look at this slide here, it's just the gist of it is that the majority of bond traders who deal with the Fed funds futures think that we are at the maximum, going to be at 2.75% to 3%. Who knows whether that's really going to happen? In other words, this chart is saying the Fed still has it wrong about the economy, that we could still have a hard landing, and therefore they might be forced to push rates quite lower than they even think.
Mhm.
Now, it, you know, 0.4% chance of the Fed funds rate of 2%. I mean, we could kind of ignore that. We kind of can ignore 2 and 2.25. But you're really, 2.5% to 2.75. There's at least a third or
That's not
close to a
nothing.
third. Yeah, and
Yeah.
like, well, I personally, I don't know if I agree with that right now. So just know that, right, that the market itself, at least from what we've learned about the Fed funds, can be wrong.